Paul, let's start with a quote that is right on the Harris Douglas website, smack dab on the middle of the main page. And it comes from you. And you say, analysis is my métier. I love that word. You sent me to my dictionary for that. I want to refresh me on what that meant. It's never a good time to buy a bad company. I tune out the noise of the sector and the economy and tear every prospective investment apart. Now, it's easy to say to an investor, tune out the noise, but what techniques have you developed over the years in order to do that and to focus on tearing down balance sheets and tearing down business models to find good investments?
Right. So I think that one of the problems with our world today that we live in, there's so much noise from all kinds of things like social media and television stations talking about the markets constantly. And so we have that's part of the reason why you have such active investors all the time. So you have to really separate that from your work, right? And so I think that I try to concentrate less on listening to all those things on a daily basis. I read the newspapers, which I think give me a good perspective on the world and the economy, but also companies. And then I actually, spend my time, don't look at my portfolio that much. In fact, I look at it maybe twice a day, once in the morning and once at the end of the day, because I don't think that's a very good way because it forces you to look at pricing all the time. And that's the worst possible way of managing money. It's not about pricing, it's about valuation and what the company can do over the long term. And if you can take away those sort of things, if you're a day trader, that's fine. But if you're a long-term investor like we are, you need to separate yourself from all that and say, are these good companies? What's the reason I bought them? Are they still there? And quarterly fluctuations, even I don't think on an earnings number really, I think makes people make bad decisions about businesses, right? So I think that's the issue. You have to separate yourself from those things to make better decisions on the investment side.
Now, in terms of the companies that you tend to drill down to and isolate, would you say that three of the main aspects and attributes that they have are competitive advantages, a sustainable high return on equity, and then valuation? You want to buy them at the right price.
Yeah, so I think that's the really important thing. You have to look for companies that really have high rates of return, right? Rates of return on capital. And I think that that's one of the problems when you look at a company is that great companies really have these consistent things. They have high rates of return on capital. They regularly beat their cost of capital. One. Number two, they have growing free cash flows. They tend to be companies that have great pricing power, good margins and continue to grow those margins. And I think that there's only a few companies that do that. There's a very small percentage of companies that you need to look at in your portfolio that are able to do those sort of things. And I think we concentrate too much sometimes on the stuff that doesn't do that. And then as a result, we actually end up having to trade out of those stocks on a constant basis, opposed to holding these great companies for long periods of time. And I think that's the key to being a good long-term investor is spending the time to find those companies. There's not many of them, and you need to find those things and hold them for the long term.
Paul, when you're evaluating companies, what are some of the red flags that pop up that immediately disqualify a company from being a possible investment?
Well, so, I'm not a big fan of really cyclical stocks. So, every portfolio is cyclical, don't get me wrong, but it's just how cyclical you want your portfolio to be. And Canadian stocks tend to be a lot more cyclical. So I stay away from those kind of companies. I stay away from companies that have really bad balance sheets. There's this misconception just because you pay a high yield that it's a great story. It's not. It may be the fact that you can't afford it. You've done other kinds of things. So the issue is that a really good balance sheet, companies that constantly beat their cost of capital and consistently and have really great cash flow dynamics with growing cash flow. I think that's free cash flow. And that's really what's important, I think. And I think that if you have a bad balance sheet, you can't do a lot of things, right? And so people forget that. There's nothing wrong with having debt, don't get me wrong. Lots of companies have debt. It's just that managing that debt effectively. In the case of something like Macy's, who took on debt to buy back their stock, that made no sense to me. That's a really bad thing to be doing. Whereas a company that uses debt in the right portion to make an acquisition, to grow their business, those are all practical things to do as a manager of a business, right? So I think you really have to look at the balance sheet and you have to look at their ability to generate better rates of return on an ongoing basis. And consistent, good companies actually do that. They do it very well, actually.
And as far as the makeup of your client portfolios, would you say you mostly hold large cap, global companies that people touch every day, or is there a bit different mix than that?
No, they are generally that. I wouldn't say they're as global as in the sense that they're in Europe or in Asia. They tend to be Canada and the United States, but they have a global presence. So if you look at some of these companies, a lot of their revenue comes from different parts of the world. So I feel that I can get emerging market exposure from a lot of these companies without actually being an emerging market. So, there's a lot of revenue base that comes from those areas. So I'm very comfortable with owning companies in the United States, especially larger cap stocks in the United States, that give me that exposure to Asia, for example, which is growing quite rapidly. So I think that's where you can do that, especially with stocks in the US, which is a much broader based economy that allows you to, and those companies tend to be global in nature. There are several Canadian companies that are like that as well, but the US companies tend to be much larger and give you that opportunity to invest internationally by buying the company in a country that you understand the accounting and the regulatory environment.
Now, on the fixed income side of portfolios, there are a lot of people who say that the 40 side of the traditional 60-40 stock bond split is dead and it's irrelevant. Do you agree with that? And have you been forced to find other ways to get fixed income and to protect the downside of your portfolios?
So I disagree with that totally. I think that what's happened is that, so one of the things is that when you've looked at really bad times in the stock market, very difficult times, I'm not talking about on an average day, but very difficult times, if stocks have collapsed, bonds have rallied. And so even this time around, I know March was a difficult time for bonds but once the Fed liquidated the system, Canada liquidated the system, bonds rallied a great deal. I think the problem that's happened is that in our business, money managers have said, oh, how do you make any money, in such low interest rate environment? And they moved clients to what I would say is riskier products that appear to be fixed income in nature, whether it's private loans, private mortgages, those sort of things, even private equity to a certain degree, but they have very different dynamics. They're very illiquid instruments. There are all kinds of issues with them. And I think that they've sold them as fixed income, and I think that will come back to haunt people in the long run, because I don't think they are fixed income. A fixed income asset, like a Government of Canada bond, gives me back my $100 at the end of the term. And that's what's key about it, right? So, and I think that there's this kind of idea that you can offset those kind of risks with these products. You may be able to, I'm not disagreeing with that short term, but there are illiquidity issues with that. I can sell a Government of Canada bond or US Treasury, in a second, and you can't exit those kind of asset classes very easily. I think they're great for pension plans, but certainly not for private clients who may want to leave your company and then they can't get out of these assets. So I think that's the problem with the fixed income side. I think that 60-40 will continue to do well, and there's still opportunities there.